All right, listen closely, because this is something every trader needs to understand before they start throwing their capital at every candle that moves on the chart. In the previous video on Rule 51, cut losses, grow profits, we talked about the discipline it takes to stop a bad trade before it eats your account alive. That was the defensive part of trading, the part most folks never learn. But today, we're going to talk about something just as critical, how to protect your profits once you've got them. Because believe me, making money in the market is only half the battle. Keeping it is where most traders lose the war. Now, let me ask you something right at the start. How many times have you been in a trade that was going your way, and instead of taking the gain, you held on a little too long, just waiting for one more uptick, one more point, one more push, only to watch the whole thing turn around on you? You had the profit in your hand, and the next thing you knew, it was gone. I've done it myself, more times than I care to count when I was young. Every trader learns that lesson the hard way at least once. You see, protecting profits isn't about being timid. It's not about snatching your gains the moment they appear. It's about discipline. The same discipline you use to cut your losses. Only this time, it's to preserve what you've earned. The market will tempt you with more every time you're on the right side of a move. That's its job. But a trader's job is to know when enough is enough. I used to tell young traders, the big money is made by sitting. But what most of them forget is that sitting doesn't mean sitting blindly. You can sit in a winning trade. Yes, but only if the market is still confirming your reason for being in it. The moment the character of the move changes, you have to change with it. The tape never lies. The chart never lies. It's only your hope that lies. Now think of this. You're in a long position, and the stock's been trending beautifully for days. You've added to your line as it confirmed strength. Everything looks fine. Then one morning it opens strong, but instead of holding those gains, it fades back by noon. The volume swells on the downside. That's the market whispering to you. It's saying, be careful, something's shifting. What do most traders do? They shrug it off. They call it a pullback. They say, oh, it'll come back. But the tape doesn't whisper twice. It tells you once, and then it moves without you. Tell me, why would you risk giving back weeks of work just because you didn't want to listen to the tape? Isn't that the same stubbornness that destroys traders on their losing trades? You see, the rule for protecting profits is really the twin brother of the rule for cutting losses. The same mindset applies. Never argue with the market. When it tells you your trade's over, you get out, not half out. Not later. Out. You protect your gains like a fortress guards its gold. And let's talk about those trailing stops, because everybody loves that term. They set a stop 3 or 4 points behind and call it protection. But it's not about mechanical stops. It's about market logic. If you bought because the trend was strong, then you stay in as long as that trend stays strong. But the moment the chart tells you momentum's fading, the volume's drying up, or the price action's turning heavy, you start scaling out. You don't need to be perfect. You just need to be practical. There's a big difference between taking profits and protecting profits. Taking profits means cashing out too early because you're afraid to lose what you've made. Protecting profits means managing your position smartly as the market shifts. That's what professionals do. The amateur tries to pick tops. The professional reads character changes. Let me paint you a picture. When a stock's moving in your favor, your paper profits feel light, easy to carry. But once it starts to slip, those same profits grow heavy in your mind. You start thinking, maybe I should have sold. You start hoping again. Hope. That's the oldest disease in the trading world. The only cure for it is rule-based discipline. That's why these rules matter. They're not optional. They're survival tools. Now, a lot of people ask me, Jesse, when do you know it's time to sell? And I always tell them, the market tells you, not your broker, not your gut, not the headlines. The tape gives you signals. Watch the volume. Watch how prices react to strength or weakness. If you see heavy volume on a decline after a long rise, that's distribution. If the stock stops making new highs even when the market's strong, that's a warning. When those signs show up, you don't wait around for confirmation from the newspapers. You act. Do you know why so many traders lose their profits? Because they treat unrealized gains like imaginary money. They think, it's not real until I sell. That's nonsense. It's your money the moment the market gives it to you. The only way you lose it is by refusing to protect it. And remember, the market doesn't owe you continuation. It doesn't have to reward your patience. It rewards understanding of conditions, of timing, of psychology. Protecting profits isn't about fear, it's about respect for the market's power to take back what it gave you. When I was trading heavily, I learned to think in probabilities, not wishes. Every trade has a lifespan. When that lifespan ends, I let it go. I didn't marry my stocks. I didn't fall in love with my winners. You can admire a stock's strength, but you can't get sentimental about it. The minute you do, it'll break your heart and your account. Now, let me ask you something. Do you think the market cares about your opinion? It doesn't. It doesn't even know you exist. So why should you trust your feelings over its facts? If the market tells you the move's ending, take it seriously. That's how you stay in the game long enough to build wealth. Protecting profits means you think like a businessman, not a gambler. A gambler bets and hopes. A businessman manages risk and capital. The market's a business, a tough one. If you don't treat it like one, it'll treat you like a fool. Sometimes, I'd see traders double their accounts in a single move, and instead of locking in even half, they'd let greed take the wheel. This is the big one, they'd say. But there's no such thing as the big one. There's only the next trade. If you protect what you've made, you're ready for it. If you don't, you'll be too busy nursing your wounds to take advantage of the next setup. And here's the truth: wealth in trading isn't built by hitting home runs. It's built by compounding discipline. You grow your stake, protect it, grow it again, and repeat. Just like we discussed in the last video about cutting losses, that same rule is mirrored here. When you cut losses, you protect capital. When you protect profits, you protect progress. Both are essential to long-term survival. Now let's talk about another mistake. Giving back too much after a big win. Every trader's done it. You have a great month, and you start feeling invincible. You start increasing your size, taking looser entries, ignoring warning signs. You think you've got the market figured out, but the moment you let confidence turn into arrogance, the market will teach you humility. That's why, after a winning streak, I always told myself, don't get reckless. Get careful. Do you know when most traders blow up? Not after losses, after wins, because profits make them careless. They stop studying the tape with the same hunger. They think the market's changed in their favor permanently. But the market never changes for anyone. It behaves the same way. It just changes how it disguises the traps. Protecting profits means protecting your mental capital too. When you guard your gains, you keep your confidence steady. You stay level-headed. You don't swing between euphoria and despair. A trader with balance is dangerous. Dangerous to the market's tricks. You must train yourself to think of every trade as a soldier in your army. If you send too many into battle and lose them, your army weakens. But if you send them wisely and bring them home safely, even if they're a little battered, your army grows stronger. Your capital is your army. Protect it fiercely. And here's something else. When a trade gives you a profit early, don't mistake that for brilliance. Sometimes it's just luck. The key question is, can you keep that profit through smart management? Because the market doesn't reward the man who makes the first dollar. It rewards the man who keeps the last. Have you ever noticed how the hardest time to sell is when everything looks perfect? That's exactly when you should be thinking defensively, because the tape's strength is most deceptive right before a turn. You'll see volume dry up, but prices still look good. That's distribution. The professionals selling into public buying. And if you're not alert, you'll end up buying what they're unloading. That's why protecting profits isn't just about stops. It's about observation. It's about feeling the rhythm of the market reading its language. You don't force your plan on it. You adapt to its tempo. You've got to ask yourself, am I trading my plan, or am I trading my emotions? When you protect profits, you're really protecting yourself from yourself. Because the hardest thing in trading isn't reading charts. It's mastering your own impulses. And this is where today's principle ties back to what we talked about in that first video on cut losses, grow profits. That rule taught you how to defend against loss. This one teaches you how to defend your victory. Both rules are about survival, and survival is the foundation of wealth in this business. You don't have to win every battle. You just can't afford to lose your capital in any single one. Now, some traders say, I'll just ride the trend until it ends. And that's fine, if you know how to spot when it ends. But most don't. They watch the price retrace, and instead of acting, they rationalize. It's just a dip, they say, but dips can turn into dives before you blink. You must be willing to sell when the evidence says so, not when your feelings do. The moment a trade stops behaving the way it should, it's no longer your friend. Don't argue. Don't wait for confirmation that never comes. The tape already told you. You just didn't want to listen. So, protecting profits means staying loyal to your rules, not your trades. And remember, every rule in trading exists to protect you from the worst version of yourself. The greedy one, the hopeful one, the careless one. The market can't beat a disciplined trader, but it can easily beat an emotional one. Now, picture your trading record over a year. Imagine every time you made a profit, you took care to lock in a portion. Half, maybe, while letting the rest run only under strict conditions. Think how much smoother your equity curve would be. That's the beauty of consistency. You might not hit the big jackpot, but you'll build a foundation that lasts. And that's how real wealth is made in the markets. Because wealth isn't about how much you make in a single trade. It's about how much you keep through all of them. Every dollar you protect becomes ammunition for the next opportunity. And the market always gives new opportunities. If you're still standing to take them, never let a winning trade turn into a losing one. That's one of those rules every trader hears, nods at, and still breaks at least once. Sometimes more than once. It sounds simple, doesn't it? You've got a profit, so protect it. Yet in the real market, with emotions running high and prices dancing, it's one of the hardest disciplines to practice. But it's also the one that separates the professional from the hopeful. You see, the market has a strange way of testing a trader's nerve right when things look best. You've got a position that's been working beautifully. You read the chart right. You timed the entry. The stock's been trending in your favor, and you're sitting on a good profit. Everything looks easy, and that's exactly when the danger begins, because comfort breeds carelessness. The moment you start thinking you can't lose, you've already set yourself up for a fall. When I was trading, I used to say, the market gives you a profit as a test, not as a gift. It's testing whether you have the discipline to keep it. Most traders fail that test because they think the market owes them continuation. They think if it's been going up, it'll keep going up. But the market doesn't owe you anything. It gives and it takes, and the only way to stay ahead is to take before it takes back. Let me ask you something. How many times have you been in a trade that looked perfect, only to watch it reverse and take all your gains, maybe even dip into red before you reacted? You tell yourself, I'll wait for it to come back. That phrase has probably destroyed more trading accounts than any other. It'll come back. Sometimes it does, but more often it doesn't. And even when it does, the emotional toll it takes on you is costly. You start second, guessing every move after that. You lose confidence in your judgment. The next time, you hesitate, and hesitation is poison in trading. Never letting a winning trade turn into a losing one isn't about greed or fear. It's about control. Control over your actions, over your capital, over your emotions. You can't control the market, but you can control your decisions. That's where your power lies. Now, some traders misunderstand this rule. They think it means you should take profits the moment you see green on the screen. But that's not it. That's fear disguised as discipline. The rule means you manage your trade intelligently. You let the move develop, you ride the trend, but you always have a plan. A point beyond which you won't allow your profit to evaporate. You can trail your stop, scale out part of your position, or lock in some gains. But you never let the market turn your success into regret. When you're reading the tape, you'll see clues. Subtle changes in behavior. A stock that's been rising smoothly starts to hesitate near resistance. The volume starts drying up. It doesn't respond to good news like it did a few days ago. Those are signs that the easy part of the move is done. That's when the professional starts thinking about defense. The amateur ignores it, thinking the move will resume. But the tape doesn't lie. The moment it stops confirming your original reason for being in the trade, your job is to protect what you've got. You have to remember the market's not a steady teacher. It's a ruthless examiner. It rewards clarity and punishes hesitation. When you've got a profit, that's not the time to relax. That's the time to sharpen your focus. Because the market will test that profit, and your reaction will reveal who's in charge. You or your emotions. Think of your profits as your soldiers returning from battle. You wouldn't send them back out without a good reason, would you? You'd let them rest, rebuild your army, plan the next campaign. But most traders send those soldiers right back into the fight, unprotected, unplanned, hoping the war keeps going their way. That's how they lose what they've earned. When I made big trades in my time, I learned to always take something off the table once the market proved me right. Even if the move had more to give, I'd secure a portion. That wasn't weakness, that was insurance. You see, a trader's confidence isn't built from making wild profits. It's built from knowing that when he's right, he keeps what he earned. That knowledge strengthens your mindset. It makes you trade better, calmer, smarter. Let me ask you again. Have you ever looked at your account and realized that if you had just sold when you were ahead, you'd be miles ahead by now? Every trader's been there. The chart showed it clearly, but your mind argued otherwise. You convinced yourself to hold, to wait, to hope. Hope. That word again. It's the most expensive emotion in this business. Hope keeps you in trades long after the reason for being in them has vanished. The truth is, the moment you stop managing your profits, you start gambling with them. And the market loves gamblers. It feeds on them. It draws them in with excitement, lets them taste success, then takes it back when they get careless. You can't afford to play that game. You must think like a professional speculator, cold, calculated, objective. Protecting your profit doesn't mean you fear the market. It means you respect it. It means you understand that what the market gives you today can vanish tomorrow if you don't defend it. The best traders aren't the ones who find the biggest moves. They're the ones who keep the profits they make. And don't misunderstand. Sometimes the best protection is patience. There are moments when a pullback is just a pause before another leg up. But you have to know the difference between a healthy correction and a real reversal. That's where your chart reading comes in. The tape shows it. In a healthy move, pullbacks are shallow, volume contracts on dips, and strength returns quickly. But when the market's character shifts, when downswings come on heavy volume, when rallies fail to make new highs, that's not a correction anymore. That's your cue to act. You have to learn to think in terms of if-then. If the stock does this, I'll do that. That's how you stay prepared. Most traders react after the fact. Professionals act on conditions. The best way to never let a winning trade turn into a losing one is to know, before you even enter, how you'll handle success. Write it down. Set your exit zones. Don't improvise when the heat is on. Every great trader I've known had one thing in common. They respected profits like they respected capital. Because profits are capital. They're future opportunity. If you give them back to the market carelessly, you've wasted the effort it took to earn them. There's another danger here. After a few profitable trades, traders often start feeling bulletproof. They loosen up their discipline, thinking their intuition is all they need now. That's when they stop setting stops, stop journaling, stop checking the charts carefully. They call it trusting their gut. But the gut doesn't pay the bills. Discipline does. A trader once told me, "I hate selling early because what if it goes higher?" And I said, "So what if it does? You can always buy again. But you can't recover from being wiped out." That's the mindset you need. Never worry about missing the last bit of a move. The top belongs to someone else. The market will always give you another chance if you still have your capital and your composure. Now, let's look at the psychology of this rule a little deeper. When you're in profit, your brain plays tricks on you. You start imagining bigger numbers. You start counting what you'll buy. You start seeing yourself as smarter than the crowd. That's when discipline slips. Your ego steps in. You forget that the same market that made you feel brilliant can make you look foolish the next day. That's why you must train yourself to stay humble in victory. Humility keeps you sharp. Sometimes, traders confuse holding with patience. Patience is waiting for the right setup or for your trade plan to unfold. Holding blindly is stubbornness. The difference is that patience is based on observation, while stubbornness is based on hope. You can't afford to hope your way through a trade. The market punishes hope. It rewards awareness. If you watch the great tape readers, you'll see how unemotional they are. A trade that turns slightly against them after showing a good profit. They don't wait for confirmation, they act. Not out of panic, but out of principle. They follow their rules. That's why they survive. And remember, this rule, never let a winning trade turn into a losing one, is really about consistency. You can't build wealth in trading if your equity curve swings wildly up and down. You need stability. You need to keep your gains so you can compound them. Protecting profits smooths your growth, steadies your emotions, and keeps you in the game for the long haul. So, next time you're in a trade that's gone your way, ask yourself, what's my plan now? How will I make sure this profit doesn't vanish? Am I protecting my success, or am I just sitting on it, hoping it lasts? The answer to that question will tell you exactly what kind of trader you are. Always scale out when the character of the trend changes. That single line can save a trader's entire year, but most people never truly learn what it means until they've paid for it in lost profits. Scaling out isn't about fear or trying to pick tops. It's about reading the truth in the tape and responding to what the market is actually doing, not what you wish it would do. Every strong move in the market, whether up or down, has a rhythm, a character, a personality. When that personality shifts, your job isn't to argue with it, it's to act. You see, trends don't reverse out of nowhere. They evolve. They slow down, lose momentum, and start showing cracks long before they actually turn. The market gives signs. Not always loud ones. Sometimes just whispers that the tide is changing. A trader who learns to hear those whispers will keep his profits. The one who ignores them will watch his paper gains disappear. Think of a trend like a train moving at full speed. When it's roaring down the tracks, you don't stand in front of it. You ride it. You stay on as long as it moves with purpose and power. But when the train starts to slow, the steam weakens and the noise fades. You don't wait for it to stop completely before you jump off. You step off gradually, safely, while it's still moving in your favor. That's scaling out. You're taking profit while there's still momentum behind you, not when you're already going backward. Let me ask you something. Have you ever been in a trade that gave you a big profit early, and then you sat on it waiting for just a little more? Maybe you even told yourself, it's still trending, I'll let it ride. Then the next day, it pulls back a little. You shrug it off. Then the day after, it dips again, and suddenly your gain is half of what it was. You feel the pressure now, but instead of selling, you wait for it to come back. It doesn't. Before you know it, you're out at break-even or worse. That's what happens when you ignore the change in character. Scaling out means you don't need to predict the exact top. You don't need to be perfect. You just need to be smart. When you sense the rhythm of the move slowing, when volume stops confirming strength, when the chart starts showing hesitation, you start lightening up. You don't dump everything at once, because sometimes a trend will resume after a rest, but you take enough off to protect yourself if it doesn't. That's professionalism. That's trading like a veteran instead of a dreamer. When I was trading actively, I never looked for perfection. I looked for confirmation. As long as the market confirmed my position, I stayed in. The moment it stopped confirming, I began to scale out. Sometimes that meant selling 1/3, sometimes half. It depended on what the tape told me. Because the tape always tells the truth if you know how to listen. Most amateurs do the opposite. They add when the trend weakens, thinking they're getting a better price. They buy dips in a topping move. They sell rallies in a bottoming move. They're fighting the market's change of character instead of adapting to it. They mistake slowing momentum for opportunity. But slowing momentum is a warning, a yellow light flashing before the red. That's when you take action, not when you start convincing yourself that it's just a pullback. Now, you might ask, what does change in character really look like? It can take many forms. It might be a loss of volume on rallies after a strong run that tells you demand is drying up. It might be sudden volatility after a steady move that tells you uncertainty is creeping in. It might be lower highs forming on the chart while the general market stays strong. That's divergence, and divergence is danger. Sometimes the tape just feels heavy. You'll see it. The price doesn't rise as easily as before. The bids don't hold up the same way. That's the character shift. Scaling out in those moments is your way of saying, I respect what the market's telling me. You're not abandoning your position, you're managing it. You're acknowledging that the easy part of the move might be over, and that what's left carries more risk than reward. Ask yourself, what's wrong with taking some profit when the evidence changes? Isn't that why you trade in the first place? To turn opportunity into realized gain. The market doesn't care about your opinions or predictions. It only responds to money flows. When those flows shift, you either move with them or you get caught against them. There's another beauty to scaling out. It relieves pressure. Once you've locked in part of your profit, your emotions calm down. You can think clearly again. You're not paralyzed by fear of missing out or fear of giving back too much. You've already booked success. That mental freedom often helps you make better decisions with the rest of your position. You can hold longer if the trend continues, or exit smoothly if it doesn't. You're playing from a position of strength. I've seen traders freeze up because they went all or nothing. They held their entire position until they were forced out, and by then, the market had already eaten their gains. Scaling out avoids the trap. It's a middle ground between greed and fear. You're not grabbing at small profits, but you're also not gambling with large ones. You're managing risk dynamically as the market evolves. Remember this, every trend, no matter how strong, ends eventually. The professionals don't wait for the official end to act. They start adjusting as soon as the rhythm changes. They can't always tell if the move will fully reverse or just pause, but they don't need to. Their goal is to make sure that when the reversal comes, they're already safe. Do you recall what we talked about in the earlier video on cutting losses and growing profits? That rule was about defense on the downside. This one, scaling out when character changes, is the defense on the upside. Both protect you from the same enemy hesitation. In one case, you hesitate to admit you're wrong. In this case, you hesitate to admit the move is done. The result is the same. Lost capital, lost confidence, lost opportunity. The great traders don't think in absolutes. They don't believe a trend is either alive or dead. They believe it's maturing, just like fruit. You pick it when it's ripe, not when it's rotten. Scaling out is how you harvest your profits before the market spoils them. You take what's ready, and if more ripens later, you take that too. But you never let the entire crop rot because you were waiting for perfection. There's another layer to this, psychology. When you scale out, you train your mind to accept imperfection. You teach yourself that missing the top is fine, that partial profit is real profit. That mindset is essential for longevity. The traders who burn out are the ones who keep chasing the exact high or low. They need to nail it. But trading isn't about nailing anything. It's about surviving long enough to keep compounding. Scaling out also helps smooth your results. Instead of big wins followed by big losses, you get consistent gains. That's what builds real wealth, steady, controlled accumulation. The market rewards consistency far more than boldness. Anyone can catch a lucky run, only a disciplined trader can repeat it year after year. Let's talk about execution for a moment. When you notice that shift in trend character, don't overthink it. Don't wait for the perfect exit signal. The market rarely gives you one. Instead, act incrementally. Sell a third into strength if the tape feels heavy. If the weakness continues, sell another third. If it strengthens again, keep the last piece with a stop that protects the profit. This way, no single decision can ruin your trade. You're not guessing, you're adapting. I used to say the market talks in behavior, not in words. And that's true. The change in behavior is what you have to spot. Sometimes it's fast, sometimes it's slow, but it always comes. The traders who pretend they don't see it are the ones who give their money back. You know, I've been around the market long enough to watch more men ruin themselves by guessing than by any other fault. Guessing is easy, and that's why it tempts so many. But in this business, the easiest habit is also the most dangerous. Do you think a man can build a fortune on guesses? No, not for long. He might get lucky once, maybe twice, but the market will take it all back sooner or later. It always does. That's why I tell you discipline will outlast any lucky streak. Discipline is the only thing that keeps a trader in the game when the guessing crowd has long been wiped out. I can't tell you how many times I've watched men crowd around a ticker tape, listening to some fellow with a sure tip. They hang on every word as if he's whispering the secrets of the gods. But here's the truth. He doesn't know. He's only guessing, just like the rest. And what happens when you buy on someone else's guess? You don't own your trade, you don't have conviction in it, and when the tide turns against you, and it always does at some point, you'll be the first to run out, because you never had a reason to be in. Tell me, how long do you think a man can last in the market if he never knows why he's in a trade? Discipline means you wait for your own setup, your own signal, your own plan. It means you stand aside when the picture isn't clear. Most men can't do that. They feel they must be in the market every day, every hour, or else they're missing something. They can't bear to watch prices move without them. That impatience, that urge to act without reason, that's guessing in disguise. Do you think the market cares whether you're in or not? No, the market will keep moving with or without your money in it. The market doesn't even know you exist. That's why discipline, not guessing, is the trader's true weapon. I learned long ago that it's not the big wins that save you, it's the avoidance of the bad losses. And the bad losses come when you guess. You may think you're being bold, you may even dress it up with some quick reasoning, but in your heart you know when you're guessing. And if you're guessing, you're gambling. The market has no patience for gamblers. It will grind you down until you've got nothing left but regrets. Now, let me ask you, do you want to trade to satisfy a craving, or do you want to trade to build something lasting? Patience is the backbone of discipline. It means waiting when everyone else is rushing. It means sitting on your hands when your instincts scream at you to act. You see, the hardest thing for a man to do in this game is nothing. But very often, nothing is the wisest course. The crowd will call you a fool for sitting out, but that's because they can't resist guessing. They see action, and they must be part of it. And 9 times out of 10, they're the ones who pay for that action. Do you see the difference between their fever and the calm of discipline? I've often said that the market is never wrong, only opinions are. And most of those opinions are nothing more than guesses dressed up as certainty. A disciplined man doesn't cling to opinions. He follows the tape, the price action, the trend. He follows what is, not what he wishes. Guessing is always about what might be, what you hope will happen. But discipline sticks to what the market is actually telling you. If you think about it, isn't it foolish to argue with the one thing that can never be wrong? A man who guesses in the market is like a sailor who throws away his compass and steers by the shape of the clouds. Maybe he gets lucky and makes land once or twice, but the odds are he'll wreck himself sooner or later. The disciplined trader, he keeps his compass, he knows where he is, and he doesn't let the sky fool him. The compass doesn't promise smooth sailing, but it gives him direction. Isn't that what you need when the waves start rising? Now, people often ask me why discipline is so hard if it's so important. I tell them it's because discipline goes against human nature. Human nature wants excitement, wants action, wants to feel alive. Guessing gives you that rush, placing a trade on a hunch, chasing a tip that gives you a thrill. But it's the same thrill a gambler feels tossing dice. The market will let you have your fun, but it will also present the bill, and the bill is always higher than you expect. Have you noticed how easy it is to start guessing once you've had a win? You start to feel you can't miss. That's the most dangerous time of all. The disciplined man knows he can miss. He knows he will miss. He knows he'll be wrong often. But here's the difference when he's wrong. He knows it quickly and acts on it. He cuts his loss and waits for the next real opportunity. The guesser, he holds on, hoping his luck will turn, guessing it will come back his way, and that's how small mistakes turn into disasters. Would you rather take a scratch and walk away clean, or would you rather guess yourself into a hole you can't climb out of? One thing I've always said is that speculation is as old as the hills, but it's never changed. Men will always look for shortcuts, always believe there's an easier way, but there isn't. The only way is the hard way: discipline, patience, study, and control. Guessing is the shortcut, but shortcuts in this game lead you right off a cliff. I ask you, if the market has beaten countless men before you, do you think it will spare you just because you guessed right once or twice? You must understand, discipline is not just about entering trades. It's about everything: your size, your timing, your exits, your rules. If you let guessing sneak into any part of that, you're weakening your whole structure. One guess leads to another, and before long, you're not trading your plan anymore, you're just drifting. That drift is fatal. Haven't you ever noticed how one undisciplined decision often snowballs into more? Discipline also means knowing when to take profits. Most men are greedy. They guess the trend will keep going just because they want it to. And then they watch their profits vanish. The disciplined trader takes what the market gives and doesn't argue. He doesn't guess the top. He doesn't guess the bottom. He takes his share and steps aside. Isn't that wiser than gambling on the unknown? Now let's talk about the crowd, because the crowd is always guessing. The crowd trades on tips, rumors, headlines. They act fast because they fear being left out. And when the crowd acts, it creates movement, but movement without foundation. The disciplined trader watches this, waits for the frenzy to burn itself out, and then acts when the picture is clear. Do you see how guessing with the crowd puts you at the mercy of their emotions? I remember times in my early years when I thought I could outguess the market. I'd jump in and out on a whim, chasing every flicker. Sometimes I'd win, but more often I'd lose, and the losses hurt worse than the wins felt good. It wasn't until I learned to sit tight, to act only when my rules said act, that I began to see real progress. The market taught me that lesson the hard way. Wouldn't you rather learn it now, with words, than learn it later with your account? Discipline also protects you from yourself. Because your worst enemy in trading isn't the market, it's you. Your own greed, fear, hope, impatience, those are what guessing feeds on. Discipline puts a wall between you and your impulses. It forces you to act on reason, not emotion. Isn't that the kind of guard you need in a world where every tick tries to shake your nerve? Another thing, guessing makes you inconsistent. One day you're a bull, the next day a bear, depending on which way the wind blows. You can't build anything on that. Discipline makes you steady. It gives you a method, and with a method, you can measure yourself. You can learn, adjust, improve. Without it, you're just tossing coins in the dark. And tell me, can a man toss coins his whole life and expect to come out ahead? The funny part is, most men know discipline is the key, yet they still fall back to guessing. Why? Because guessing is easier in the moment. It requires no preparation, no patience, no restraint. but it costs you more in the long run. Discipline, on the other hand, costs you effort up front, but it pays you dividends over time. So I ask you, do you want the short thrill of a guess, or the lasting satisfaction of control? I'll say it again, it's not what you make that counts, it's what you keep. And you'll only keep what you earn through discipline. Every fortune I've made, and every fortune I've lost, has traced back to that truth. When I was disciplined, I prospered. When I guessed, I paid. That's the plain record. Isn't that enough evidence for you? Guessing in trading is just gambling. Discipline builds longevity. That single idea has broken more men than they care to admit, and it has saved the few who chose to listen. You see, anyone can put money into the market and hope for the best. Hope is cheap, guessing is easy, and gambling comes natural to human nature. But what happens when the market turns against that guess? What happens when the luck that carried a man yesterday abandons him tomorrow? The market doesn't forgive. It doesn't care whether your hunch was strong or weak, whether you felt certain or half certain. It doesn't care if you guessed right 3 times in a row. The 4th time can take back everything, and then some. That is gambling. That is what guessing really is when you strip away the excuses. Now discipline, on the other hand, is the opposite of gambling. Discipline means you have a reason, a rule, a structure for every move. It means you act only when conditions meet your requirements, not when a whim stirs in your chest. Think about it, would you walk into a casino and expect to come out ahead if you kept betting on whatever number felt lucky? The answer is no, and yet men walk into the market every day and do the same thing with their capital. They buy because a friend said so, they sell because they feel nervous, they switch positions because a headline rattled them. That's nothing but gambling in disguise. Have you ever caught yourself doing the same? The difference between guessing and discipline shows most clearly in how a man reacts to loss. The guesser takes a loss and immediately tries to make it back on another hunch. He doubles down, he changes direction, he chases every flicker of movement, desperate to recover. He is ruled by emotion, by the fear of being wrong, by the hope that maybe his next guess will save him. And more often than not, that cycle grinds him into dust. The disciplined trader takes the loss as part of the game. He knows losses come, and he knows they are manageable so long as he follows his rules. He cuts the position, clears his head, and waits. He does not scramble for the next coin toss, because he never entered the first one on a coin toss. Which kind of trader do you think lasts longer? Longevity in this business isn't built on one big win, no matter how sweet that win feels. It's built on surviving the long run, year after year, cycle after cycle. Guessing will never give you that. Guessing will maybe hand you one strong season, but then the wheel turns, and the game shifts, and your guesses stop lining up with reality. Discipline doesn't depend on the season. Discipline adjusts, adapts, and carries you through because it is rooted in process, not chance. Tell me, do you want to be remembered as a lucky player for a year, or a steady operator for a lifetime? Another way to look at it is this: guessing makes you a victim of the market. Discipline makes you a student of it. The man who guesses throws himself at the mercy of every swing. He's reactive, always behind the curve, chasing what just happened instead of preparing for what could unfold. The disciplined man studies, prepares, and waits. He is not surprised when the market shifts, because he has already decided what he will do if it happens. He is not desperate to grab at every opportunity, because he knows there will always be another, and only the right ones matter. Do you see the difference between being a victim of chance and a master of preparation? The market feeds on guessers. They are the lifeblood of its movements. Their money becomes the fuel that drives the disciplined operator's account higher. Every time a crowd of guessers piles into a stock on rumor, they create the conditions for the disciplined man to take advantage when the truth shows itself. That's how it's always been. Speculation thrives on the impatience of the masses. So if you find yourself swept up with the guessing crowd, ask yourself, do you want to be part of the fuel that burns away, or do you want to be the fire that endures? It's worth remembering that the market is designed to tempt you into guessing. Prices move quickly, Headlines shout urgency. Other traders brag about sudden gains. All of it is bait for the undisciplined. The ticker tape never sleeps, and it whispers to the weak-nerved man that he must act now, before it's too late. That whisper leads straight to guessing. Discipline is the ability to ignore that whisper until your rules line up with action. Can you imagine how much strength it takes to do nothing when the crowd screams for action? That strength is what separates the gambler from the operator. Let's talk about emotions, because guessing is nothing more than emotion in action. Hope, fear, greed, excitement, these are the seeds of every guess. You see a stock rising fast and you hope it will keep going, so you jump in without a plan. That's guessing. You watch a position dip a little and you fear it will fall further, so you sell without thought. That's guessing too. You hear of someone making a killing in a hot sector, and your greed pushes you to buy the same thing late in the move. Guessing again. Now compare that to discipline. Discipline strips emotion out of the process. Discipline says, here is my signal, here is my stop, here is my target. Until the conditions match, I do nothing. Doesn't that sound calmer, steadier, more controlled than chasing every flicker of feeling? Guessing also gives you no foundation for growth. If you win by guessing, what do you learn? Nothing, except that you were lucky. You cannot repeat it reliably, you cannot build on it, you cannot scale it. Discipline, though, creates a record you can study. You can see what worked, what didn't, where you followed your plan, where you slipped. That feedback is gold. It makes you sharper over time. The guesser has no feedback, only a string of random wins and losses that teach him nothing. Isn't progress in skill worth more than the fleeting thrill of a lucky break? Even in the short run, guessing wears you down. It drains your energy because you're always on edge, always reacting, always second-guessing yourself. Discipline conserves your energy. You wait quietly until your conditions arrive, then you act decisively, without hesitation. You know what to do before the moment arrives. That steadiness lets you trade longer, think clearer, and keep your balance. Longevity in this business isn't just about money, it's about mental stamina. How long do you think a man can last if every day feels like a coin flip with his fortune on the line? The simple truth is that the market doesn't owe you clarity, but discipline allows you to function, even when clarity is scarce. Guessers try to force clarity by acting on incomplete information, hoping it will turn out well. That's gambling. Discipline accepts uncertainty and waits for the market to show its hand. One path tries to force the world into your plan, the other waits for the world to align with it. Which path do you think the market respects? You must understand, every fortune that lasts in this business was built on discipline. Luck and guessing may create a flash of wealth, but that flash dies as quickly as it came. Only discipline builds the foundation strong enough to endure the storms. And there will be storms. Every trader faces them, and only those with rules, patience, and restraint make it through. Guessers are washed away in the flood. And you building your house on sand or on rock. Patience to wait for clear signals is harder, but safer than chasing action. That single truth has humbled more traders than any market crash. Because it runs against everything in a man's nature. The market flickers every second. The tape prints new numbers without rest, and every movement whispers, act now, don't wait, you'll miss it if you sit still. Most men can't resist that whisper. They see price jump, they see others rushing in, and they leap without a plan. That is chasing action. It feels alive, it feels thrilling, but in the end it empties more accounts than it fills. Waiting, true waiting, requires a discipline that feels like punishment at times. But it's the kind of punishment that saves you. Patience is not just sitting on your hands blindly. It's sitting with purpose, with a rule in mind, with conditions laid out in advance. The patient trader is not idle, he is watching, measuring, preparing. He knows what his setup looks like, and until the market shows him that picture, he refuses to move. Compare that to the man who chases every flicker. He doesn't wait for alignment, he doesn't need confirmation. He convinces himself that action alone is progress. But is it? Think of a man rowing furiously in circles. He exerts himself, he sweats, he feels busy, yet he goes nowhere. isn't that the same as chasing without patience? The hardest thing to explain to a young trader is that doing nothing can be the most profitable action of all. He thinks every hour not spent in a trade is wasted. He believes the market owes him an opportunity on demand. But the market owes nothing. The market only reveals itself when it's ready, and those moments are far fewer than the crowd thinks. The patient man accepts this. He knows that trading is not about being in the market all the time, it's about being in the market at the right time. The impatient man cannot bear that thought, so he forces trades where none exist. Tell me, who do you think pays the price for that impatience? Chasing action is rooted in fear of missing out. You see a stock rallying and think, if I don't get in now, I'll miss the move. So you buy high, without a signal, without a plan. Then the rally stalls, the price pulls back, and you're left holding the bag. Or you see others profiting and you feel left behind, so you jump in late. That is the mind of a chaser. Patience frees you from that trap. Patience says, there will always be another trade. If I miss this one, it doesn't matter. My rules will lead me to the next. Doesn't that sound steadier than living in constant fear of missing out? Clear signals are like solid ground. When you see them, you know where you stand. They don't guarantee success, nothing does, but they tilt the odds in your favor. Acting without them is like stepping into quicksand. You might stay above the surface for a moment, but sooner or later you sink. The chaser trades in quicksand because he cannot wait for the firm ground of confirmation. The patient trader builds his moves only on solid ground. Which foundation do you think holds up in the long run? Patience is also protection against noise. The market produces endless noise, tiny movements, sudden spikes, false breakouts. If you react to every one, you'll be whipsawed into ruin. The patient trader filters the noise by waiting for patterns to confirm, for setups to mature. He doesn't mistake every flicker for a signal. Chasing action is the art of mistaking noise for opportunity. Waiting is the art of separating the two. Have you noticed how many times you've been lured by a sudden move, only to see it reverse the moment you enter? That is noise punishing impatience. Another truth is that patience conserves capital. Every unnecessary trade costs money in commissions, spreads, slippage, and losses. The chaser bleeds from 1,000 small cuts. The patient trader bleeds rarely because he only enters when the opportunity is clear. Over time, that difference is massive. Longevity in the market isn't just about making money, it's about not wasting it. Do you see how every impatient trade shortens your runway, while patience keeps your powder dry for when it really counts? But patience is not natural. It must be trained. Human instinct pushes us toward action, not inaction. We equate movement with progress, silence with wasted time. The market preys on this instinct. The tape is a constant invitation to act, and the crowd reinforces it. When you're sitting out, others will call you timid, or foolish, or lazy. They'll brag about the trades they're in, the gains they're making. It takes strength to endure that pressure and remain still. Yet that very strength is what separates the survivor from the casualty. Can you see why patience is rarer than guessing? I've seen men ruin themselves simply because they couldn't wait. They had capital, they had knowledge, but they lacked patience. They forced trades in dead markets. They chased rallies too late. They bought weakness before it was finished. They wanted action more than accuracy, and the market punished them for it. On the other hand, I've seen men of modest skill thrive simply because they had the patience to wait for perfect conditions. They didn't trade often, but when they did, their trades counted. Isn't it remarkable how restraint can outshine brilliance? Patience also gives you clarity of mind. When you're chasing action, you're in a constant state of rush, always reacting, always second-guessing. That stress clouds your judgment. You start seeing signals where none exist, just because you want them to be there. But when you wait calmly, you see the market as it is, not as you wish it to be. You're not forcing patterns, you're recognizing them. That clarity is priceless. How many times have you looked back at a hasty trade and thought, if only I had waited a little longer, the truth was obvious? Even when a patient trader misses a move, he loses nothing. His account is untouched, his mind is calm, and another opportunity will come. But when the impatient man misses a move, he often pays twice, once by losing money chasing late, and again by losing peace of mind. He obsesses over what he missed, he forces the next trade even harder, and the spiral continues. Patience frees you from that spiral. Wouldn't you rather miss a move cleanly than be dragged through the mud chasing it? It's important to understand that patience is not passivity. It's active waiting. It's preparation. While others are rushing into every candle, the patient trader is studying, planning, rehearsing his entry and exit. By the time his signal appears, he is ready. The chaser, by contrast, is always unprepared, scrambling to react, improvising under pressure. One is calm, the other is frantic. In a game where calmness equals control, which side would you rather be on? The discipline of patience also compounds over time. The more you practice it, the stronger it becomes. At first it feels unbearable, you itch to act, you fight the urge, and you feel you're missing out. But with each time you resist, you see the benefits. You see how much money you save by not chasing, how much clearer your decisions become, how much steadier your account grows. That reinforces the habit until waiting becomes second nature. Then you no longer suffer from the itch to act, you wait easily, because you trust your process. Isn't that worth cultivating? The truth is, most fortunes lost in the market were lost through impatience. Men could not wait for clarity, so they jumped into fog. They believed they could navigate blind, but the fog swallowed them. The few who endured were those who waited for the fog to lift before taking a step. And still today, the same law applies. The market has not changed, only the faces of the players have. And the question remains, are you the man who chases every flicker, or the one who waits for clear skies? Guessing may bring quick thrills, but discipline delivers lasting survival. That's the kind of lesson the market writes in ink that never fades, because it comes from the oldest law of speculation. Excitement is cheap, endurance is costly. The crowd always confuses the two. They chase the fast thrill of being right once, twice, maybe 3 times on pure luck, and they tell themselves they've mastered the game. But the market, patient as it is merciless, waits to prove them wrong. It doesn't care about how clever you felt on a lucky day. It only cares how steady you can be through 100 different days. And steadiness never comes from guessing, it only comes from discipline. The thrill of guessing is seductive. You see a sudden move, you feel the rush of opportunity, you act without hesitation. When it goes in your favor, the excitement is intoxicating. You feel sharp, you feel alive. You tell yourself you saw something others didn't. But deep down you know it wasn't skill, it was chance. And chance is a fickle ally. The next time, and the time after that, it will betray you without warning. Tell me, how long do you think a man can survive if his entire livelihood depends on the whims of chance? Survival in the market is not about one good trade, or even a handful of them. It's about staying in the game long enough to let your edge compound. The man who relies on guessing may survive a season, but the man who relies on discipline survives a lifetime. That difference is everything. Discipline is the set of rules that shields you from ruin. It tells you when to enter, when to exit, when to stand aside. It strips away the thrill, but in exchange it gives you endurance. Which matters more, a moment of excitement or a future that stretches far enough to actually build wealth? The thrill of guessing is a trick your own mind plays on you. When you're right by luck, it feels better than being right by method. Why? Because it strokes your ego. You believe you outsmarted the market, you beat it at its own game. But no one outsmarts the market for long. The disciplined trader doesn't seek that kind of satisfaction. He doesn't need the thrill. He finds contentment in following his plan, whether the trade wins or loses. His pride comes not from guessing right, but from executing right. Isn't that a sturdier foundation for survival than the fragile high of a lucky guess? Every great collapse I've witnessed had guessing at its core. A man builds a streak, feels invincible, and raises his size without rules. He mistakes fortune for genius. Then comes the inevitable reversal. One bad guess, magnified by his overconfidence, wipes out months or years of progress. That's the cost of chasing thrills. Discipline, on the other hand, prevents the blow-up. It caps your losses, it It keeps your size in line. It stops you from believing you're bulletproof. You might not get the same wild highs, but you avoid the devastating lows. Would you trade fleeting euphoria for lasting security? The problem with thrills is that they demand more. A small win excites you once, but the next time you need a bigger win to feel the same rush. This is how gamblers destroy themselves. They escalate their risks chasing the feeling, not the profit. Guessing in the market follows the same pattern. One hunch isn't enough. You need another, then another, each bolder than the last. Eventually the market catches you leaning too far, and down you go. Discipline doesn't demand escalation. It is steady, consistent, repetitive. It may feel boring, but boring keeps you in the game while the thrill seekers burn out. Do you want excitement or do you want survival? Discipline also transforms your relationship with loss. When you guess, a loss feels crushing because it exposes that you never had control to begin with. It shatters the illusion of your luck. That pain pushes you into revenge trading, chasing the thrill of redemption. When you operate with discipline, a loss is just part of the plan. It stings, but it doesn't unnerve you. You already accounted for it, and you already know how to respond. That calm response is what allows survival. Isn't it clear how much safer it is to accept small losses with discipline than to spiral after a guessing loss? Survival is not glamorous, but it's the only thing that matters. The market doesn't reward the flashiest trader, it rewards the one still standing after the rest have fallen. Guessing might give you a headline, a story to brag about at a dinner table, but discipline gives you longevity, and longevity is what turns trading from a game of chance into a business. Would you rather have one story of a lucky strike or a lifetime of steady results? Think about the crowd for a moment. The crowd thrives on guessing. They need the excitement, the drama, the daily rush. They chase tips, they follow rumors, they act on headlines. Their accounts rise and fall like a roller coaster until eventually the falls outnumber the rises. They crave survival, but they sabotage themselves with their hunger for thrill. The disciplined operator lets the crowd play its game because he knows their guessing creates the very opportunities his rules exploit.